Here's a stark reality. Over 50% of international joint ventures fail within the first 5 years, and cultural misalignment is cited as a primary reason in a significant portion of these failures. In India, entering this market through a JV demands more than a signed contract. In this video, we look at how to identify the right Indian partner, emphasizing hard-nosed due diligence, genuine cultural alignment, and legally sound strategies that go beyond the boilerplate agreements to avoid becoming another statistic. Successful long-term joint ventures in India hinge on rigorous due diligence, deep cultural understanding, and comprehensive legal frameworks tailored to the Indian context, directly impacting the high failure rate of such partnerships. Effective due diligence requires quantifiable metrics across operations, market standing, ethics, and strategy, directly impacting the long-term viability of the JV. You'll check financials, but quantify these too: operational capability and scalability. Don't just see a factory, assess their production efficiency. For example, units per man hour or defect rates. Aim for benchmarks within their industry in India. Look at supply chain reliability. On-time delivery rates, supplier retention, look for rates above 85 to 90%. Look at scalability potential. For example, available capability for a projected 20 to 30% growth in the JV's output. Market reach and reputation. Don't just hear that they have a network. Quantify their market share in key target segments. Aim for a partner with at least a top 3 position in the relevant niches. Look at customer retention rates. Rates may be ideally above 70 to 75%, and net promoter score or similar customer satisfaction metrics. Ethical and legal track record. Don't just check for major lawsuits, analyze their history of tax compliance. Ideally aim for a clean record for the past 5 to 7 years. Look at environmental incident reports. Ideally seek 0 significant violations, as well as employee turnover rates, because high turnover can signal underlying issues. Strategic and financial alignment. Don't just talk vision. Quantify their average annual revenue growth over the past 3 to 5 years. Aim for a growth rate comparable to your market entry targets. The debt-to-equity ratio should also be below 1:1 or as per industry norms, and projected ROI for the JV should be based on realistic market penetration scenarios. Demand clear and data-backed projections. Cultural alignment needs tangible evaluation beyond surface-level interactions, impacting communication efficiency, decision-making speed, and overall partnership harmony. Good vibes aren't a metric. Assess communication effectiveness. Evaluate their response time to inquiries. Aim for a consistent and timely communication within 24 to 48 hours. Observe clarity and directness in internal and external communication, and assess their willingness to invest in language and cross-cultural training, which is a tangible commitment. Decision-making, speed, and autonomy. Understand their typical decision-making cycle for significant projects. Document expected timelines and approval layers, and the level of autonomy that they are willing to grant the JV management team. Over here, clarify reporting structures and approval thresholds upfront. Value and ethical congruence. Conduct joint workshops on core values and ethical standards, document agreed-upon principles in the JV agreement, and establish clear mechanisms for reporting and addressing ethical breaches. For instance, a zero-tolerance policy with defined consequences. Hierarchy and relationship dynamics. Observe the internal hierarchy and respect for seniority during meetings. Understand their approach to building long-term relationships. There should be evidence of sustained partnerships over 5 years. And assess their willingness to integrate your team and adopt collaborative work styles. Legal agreements must incorporate India-specific clauses and mechanisms to safeguard interests, address unique legal precedents, and ensure enforceability. Your standard contract isn't enough. Include the following: India-specific governing law and jurisdiction. Explicitly state that Indian law governs the agreement and specify the jurisdiction for dispute resolution within India. Robust intellectual property protection with an India focus. Detail IP ownership, registration responsibilities under Indian IP laws, and enforcement mechanisms within India, including penalties for infringement. Here include clauses for regular IP audits and proactive enforcement measures. Detailed dispute resolution with an escalation matrix. Implement a multi-tiered approach starting with mandatory mediation under Indian law, for instance, the Arbitration and Conciliation Act, followed by arbitration in India with clearly defined rules and timelines. Over here, stipulate a maximum time frame for each stage of dispute resolution. Comprehensive exit strategies and valuation clauses aligned with Indian regulations. Outline clear exit scenarios, for example, change of control, breach of contract, pre agreed valuation methodologies based on Indian market practices, and the process for share transfers in compliance with Indian company laws and tax regulations. Over here, also include clauses addressing potential tax implications of exit for both parties. Force majeure and change in law clauses, specific to India once again, include clauses that specifically address potential disruptions common in India, for instance, significant policy changes, local unrest, or infrastructure failures, and outline responsibilities and remedies. Here are a couple of real life examples. The first one is of cultural misalignment. A Western manufacturing firm partnered with an Indian family owned business. Now, the Western firm's direct communication style clashed with the Indian partner's more indirect approach, leading to misunderstandings and mistrust. The centralized decision making of the Indian partner slowed down crucial project approvals, frustrating the Western firm's need for agility. The JV dissolved within 3 years due to irreconcilable differences in operational styles and communication. Another example of failure is due to due diligence neglect. A European retailer entered a JV with an Indian distributor based largely on claimed market research. However, limited operational due diligence revealed a weak logistics network and a history of quality control issues with their existing partners. This resulted in significant supply chain disruptions and damage to the European brand's reputation, leading to a costly and premature exit. There are also some success stories. Here's one example of a strong legal and strategic alignment. A US technology company partnered with an Indian IT services firm. They invested heavily in legal counsel with expertise in Indian JV agreements, clearly defining IP ownership and exit strategies. Both partners had a shared long term vision for market penetration and agreed on clear performance metrics and decision making processes from the outset. This JV has thrived for over a decade, leveraging the Indian partner's local market access and the US firm's technology. Another success story is about proactive cultural integration. A Japanese automotive component manufacturer partnered with an Indian auto ancillary company. They invested significantly in cross cultural trainings for both teams, established joint management committees with clear communication protocols, and fostered strong personal relationships at all levels. This proactive approach to cultural integration facilitated smooth collaboration and contributed to the JV's sustained profitability and growth. Don't treat finding an Indian joint venture partner as a mere contractual exercise. Success hinges on a data driven, culturally intelligent, and legally fortified approach that goes far beyond the surface. The failure rate speaks volumes. Therefore, prioritize comprehensive due diligence, genuine cultural alignment, and legally sound agreements tailored to the Indian context to build a partnership designed for long term success.